Good afternoon, ladies and gentlemen. Welcome to the Randall and Quilter Investments Holdings Limited investor presentation for the interim results for the 6 months ended 30th of June 2021. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time via the Q&A tab situated on the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. You'll be notified once these are ready for your review. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to William Spiegel, Chairman, and Thomas Solomon, CFO of Randall and Quilter Investments Holding Limited. Good afternoon.
Good afternoon. Thank you very much. I'm William Spiegel, the Executive Chairman of Randall and Quilter, and I'm here with my partner and our CFO, Tom Solomon, and we're pleased to present you with our H1 2021 results. We're going to put ourselves, Tom's going to go on mute. We're going to take ourselves off the camera as we go through this presentation. We'll be back for Q&A. So today's presentation is divided into two parts. The first part, we're going to discuss some important strategic updates and how we're growing our legacy insurance fee income. And the second part of the presentation will review the details of our H1 2021 results. Before I begin, though, let me give you some key highlights that we'll then go into detail on over the course of the presentation. As we have been clear about, we are in our 5-year strategy, we are moving Rnq to be a largely fee-based business model, which is capital lighter, simpler to understand, simpler to model and forecast. We're doing this, number two, by turning legacy insurance into a fee-based model by raising Gibson Re. And you'll hear more about this later, but Gibson Re is a legacy insurance sidecar. And this move changes the timing of legacy insurance earnings from episodic and upfront day one underwriting income to a higher quality and predictable annual recurring fee income, which we should earn over at least a 6-year period. Gibson Re allows us to be fully funded and benefit from the growing legacy insurance market in a capital lighter way. We won't need to raise any equity at Rnq. If I switch briefly to program, in program, the highlights are we have increased our target 2023 gross written premium to $1.75 billion from $1.5 billion. And I just want to note that in H1 2021, our pre-tax operating profit margins for program were 40%, up from 7.5% a year ago. As we transition our business model and earnings pattern, by 2023, we believe our pre-tax operating profit, which will be largely based on fee income, will be greater than $90 million. I want to briefly comment on H1 21 results. Both of our businesses are meeting or exceeding expectations, but our results in the first quarter were impacted by the timing of legacy deals. That's the episodic nature I was referring to earlier, which will go away as we put Gibson to work. And finally, before we get into the details of the presentation, we're committing to our progressive dividend policy of growing our dividends from the 4p per share we paid in 2020, and we are paying an interim dividend of 2p per share. So with that, I want to go and talk about the strategic changes and dig into Gibson Re a little bit more. So as I mentioned at the outset, we have been very clear that our 5-year plan is to become a more capital efficient, fee-oriented business, focusing on our core strengths of insurance origination, underwriting, and claims management. We're very fortunate to have accelerated this plan, moving our business from being this balance sheet intensive business with episodic earnings and a reliance on the equity markets to support growth to a capital lighter and more predictable fee-based model. We're becoming an annual recurring fee business. This is occurring because of the formation of Gibson, this legacy reinsurance sidecar I mentioned earlier, which transitions legacy insurance into more of an asset manager of legacy insurance reserves. More on Gibson shortly. But legacy now joins our program management and MGA investments in generating most of its future revenues from annual recurring fees. At a high level, and on a go-forward basis, Rnq will have 3 fee businesses. In legacy insurance, Rnq will manage Gibson Re for a fee of 4.25% of reserves for at least 6 years. Our program management business is developing exceedingly well and continues to grow. At the end of August, we had 68 programs with annualized fee income of over 50 or approximately $50 million. Given our trajectory, as I mentioned, we are increasing our 2023 gross written premium target to 1.75 billion from 1.5 billion. And so that you recall, in program management, we charge 5% of gross written premium. And finally, we own 40% of tradesman program managers and receive quarterly distributions equal to our 40% of profits. Tradesman is one of our largest MGA relationships, and it is grown strongly with H1 2021 annualized net income of 31 million. Before we get into the details of Gibson, I really want to remind you of the secular growth in the legacy market. As we have discussed previously, legacy insurance has become a key provider of capital management solutions to the insurance industry. According to PwC, global runoff liabilities stand at $860 billion, and more of this is becoming addressable as the legacy industry matures. You can see Rnqs growth over the last few years, as we have leveraged our broad global platform to grow our business. We did 276 million pounds of reserves in 2019. We grew to 500 million pounds of reserves that we acquired in 2020. And our pipeline today is over $1 billion. Not all of that we will do, of course, but we are continuing to see a lot of demand for our business. And under our previous model, that would have required a lot of capital to grow. So what is Gibson Re? Gibson Re is a $300 million Bermuda domiciled collateralized reinsurer that is owned by sophisticated investors. Rnq is not an investor in Gibson Re. Gibson Re, though, allows Rnq to acquire $2 billion or so of legacy reserves and fund our legacy business over the next 3 years. This reduces the need for Rnq to raise equity. It diversifies our funding away from traditional capital markets, and it frees up our capital to support growing dividends. What Gibson Re will do will reinsure 80% of all of Rnq's legacy reinsurance transactions over the next 3 years, and Rnq will manage Gibson Re's reserves for at least the next 6 years for a fee of 4.25% of those managed reserves. Beginning in year 7, Rnq will also offer to commute or purchase any remaining reserves in Gibson Re, providing a new distribution channel for our legacy reinsurance business. And it'll be on a book that we know exceedingly well. Our expectation is that we can continually raise Gibson Re type deals or sidecars so we can continue to support our business, our legacy business. Let me show you how this works technically with this chart. A client works with Rnq, and Rnq assumes the legacy insurance. We then cede 80% of that insurance to Gibson Re. Gibson, as I mentioned, is funded by third-party investors, and that those third parties will collateralize the risk. The key points are there is no cherry picking. All of our legacy insurance transactions will go into Gibson. Point number 2, we are using the same underwriting standards that we use today and the same investment strategy. And point number 3 is Rnq will hold 20% of the risk to ensure alignment of interest. Let me now turn it over to Tom to show you how Gibson Re turns legacy insurance into an asset manager with a predictable and high quality earning stream. Tom?
Thanks, William. As mentioned, 80% of Rnq's upfront underwriting income will be replaced with annual recurring fee income. The deployment of $300 million of Gibson Re capital over the next 3 years should allow for the acquisition of approximately $2 billion of reserves, of which $1.6 billion, or 80%, will be ceded to Gibson Re, and approximately $400 million, or 20%, will be retained by Rnq. To illustrate the earnings potential of legacy insurance transactions over the next 3 years, we have assumed that Rnq will earn upfront underwriting income of approximately 15% on the acquired reserves it retains, investment income of 2% on those retained reserves and the allocated capital to it, and annual fee income of 4.25% on reserves ceded to Gibson Re. We estimate that by year 3, gross operating income of future legacy transactions will amount to approximately $75 million, which comprises $50 million of annual recurring fee income while requiring little to no equity capital from Rnq. Our outlook for future fee income is robust. Our H1 2021 annualized fee income of $50 million is based on $890 million of gross written premium and our 40% stake in Tradesman. Based on our updated guidance of $1.75 billion of gross written premium by 2023, which is approximately $900 million more than what we write today, and 5% program fees, we estimate that we will earn an incremental $40 million of fee income in program management over the next 3 years. As we explained on the prior slide, we expect to earn $50 million of run rate fee income from legacy insurance transactions ceded to Gibson Re by the end of year 3, assuming all of the capital of Gibson Re will be utilized. In total, we expect our fee income to be over $140 million by 2023 on a run rate basis. Gibson Re changes the timing of when we recognize revenues, but most importantly, it increases the quality of those earnings. Our business continues to perform in line with market expectations, although we would require additional equity capital to support legacy insurance growth. With the formation of Gibson Re, we expect our pre-tax operating profit in 2021 to be relatively flat to the $20 million we earned in fiscal year 2023, depending on when we complete legacy transactions. This is due to the loss of 80% of upfront underwriting income in exchange for annual recurring fee income that will grow over time. Nonetheless, we will not require any additional equity capital to finance this growth. We expect to grow to over 90 million pre-tax operating profit on a run rate basis by 2023, assuming Gibson Re's capital is fully utilized. We expect to grow our fiscal year 2021 dividend from 4 pence per share paid in fiscal year 20 with the benefit of excess capital created by Gibson Re. Hence, our payout ratio will likely be meaningfully above the high end of our 25 to 50% target payout range for 2021. And now I want to turn it back to William.
Thanks, Tom. So this is a slide we have used in every presentation over the last 18 months. And we believe our business is a combination of a fee business and a specialty insurer. And hopefully we'll get that valuation in the market. What has changed with the formation of Gibson Re is that we have moved future legacy insurance underwriting profit into becoming a recurring fee business, increasing the size of our future fee bucket. Now let me discuss the H1 results in a little more detail. So I'll give you the highlights. At the group level, as I mentioned at the outset, we had a pre-tax operating loss of $24 million, which would have been break even if we included the 2 legacy deals we have signed but are waiting to close. This is exactly what we mean when we say legacy is episodic. Note that historically 70% of our legacy insurance transactions occur in the second half of the year as measured by reserves. Program management, if I switch there, continued to grow and had a record first half on all key metrics. Gross written premium was $445 million, up 80% versus the prior period. Pre-tax operating profit was $10 million, an 11 times increase over H1 2020, and pre-tax operating margin was 40%, up from 7.5% in H1 2020. Legacy insurance completed 8 deals with $113 million of reserves, and as I mentioned, another 2 are signed and waiting to close with $60 million of reserves. Legacy insurance also completed the first insurance business transfer between 2 unrelated parties in the US, and we believe this will open up a new avenue for legacy growth in the United States. We maintain a strong solvency and leverage position. And finally, as we've mentioned a couple times, the board of Rnq has declared an interim cash dividend of 2 pence per share in line with our progressive dividend strategy of growing our dividend from the 4p per share we paid in fiscal 2020. And now I'll turn it over to Tom to go into the details.
Thanks, William. Due to the seasonality of legacy insurance transactions, which tend to complete in the second half of the year, we incurred a pre-tax operating loss of $24 million during the first half of 21. Had we included 2 legacy insurance transactions that were actually signed, but we're not expecting them to close to the end of this year, our pre-tax operating profit would have been break even. As we explained in our fiscal year 20 results, we focus on pre-tax operating profit, which is a proxy of run rate cash earnings and includes unearned program fee revenue and excludes intangible assets created from legacy insurance transactions, mark-to-market changes in our fixed income assets, and non-core one-time items. Our IFRS loss before tax was $45 million when including these non-cash, non-core items in the first half of the year. As mentioned earlier, we are paying an interim cash dividend of 2 pence per share with the objective of growing the annual dividend paid in 2020 of 4 pence per share. Our gross operating income was down 29% due to the timing of legacy transactions and its impact on underwriting income. Nonetheless, we continue to experience strong growth in fee income, which was up 135%, driven by growth in program fee revenues and our 40% stake in tradesmen. Investment income was up 31% due to assets acquired in legacy transactions that have been completed over the past 12 months. We will discuss the results of program management and legacy insurance on the next couple of slides. Our corporate other segment, which includes unallocated costs and interest expense on our debt, decreased 27% due to the higher allocation of costs to our operating segments, partially offset by the increased interest expense associated with the raise of $125 million of subordinated debt last year. Program management continues to experience meaningful growth. Gross written premium and fee income increased 80% and 135% respectively over the same period last year. Underwriting income on approximately 5% of the retained risk generated a loss of $1.2 million due to the purchase of stop-loss reinsurance to reduce earnings volatility. Excluding this stop-loss reinsurance, we generated an underwriting profit of $1.4 million, which is indicative of the profits assumed by our third-party reinsurers. We expect the impact of stop-loss reinsurance to continue to decrease over time as we diversify our programs. Our fee income includes both our program fee revenues as well as our 40% stake in tradesmen, which increased from 35% earlier this year. Tradesmen contributed $5.8 million to the $25 million of fee income realized in the first half of 21. Fixed operating expenses were up 59% due to higher allocation of corporate expenses and the expansion of staff to support our excess and surplus lines business. Most importantly, our pre-tax operating profit has grown over 11 times, and our pre-tax operating profit margin is at 40% versus 7.5% last year, proving the benefits of scale. As discussed, legacy insurance was negatively impacted by the timing of transactions, which tend to complete in the latter half of the year. We completed 8 transactions with $113 million of reserves, which contributed $20 million of underwriting income, down 66% from the same period last year when we experienced an unusual level of sizable legacy deals. Our investment income was up 24% due to acquired assets over the past 12 months. Our fixed operating expenses were up 46% due to higher allocation of corporate expenses. We had a pre-tax operating loss, of $15 million. Had we included the 2 signed deals that will close later this year, our pre-tax operating profit would have been $8 million. Our $1.7 billion investment portfolio continues to be high quality, with over 93% in investment grade liquid fixed income assets. We earned 1.4% yield on an operating basis, which excludes realized and unrealized net investment gains on fixed income assets. This is down about 30 basis points from last year due to a lower interest rate environment and a decrease in US dollar denominated assets as a result of investments acquired in legacy insurance transactions. Our duration remains low at 2.7 years. However, we are beginning to extend bond maturities. Now back to William on our 5-year strategy.
Thanks, Tom. So this is a slide that we used in announcing our 2020 results. So we wanted to give the market and our investors a view as to where we're heading over the next 5 years. And as I said at the outset, we want to be a capital efficient, fee-oriented, data-driven company, focusing on our core strengths of insurance origination, underwriting, and claims management. And this is implemented by 4 key initiatives. We're having great success in all of these initiatives, but as you can hear today, we are particularly excited about our job of increasing fee income and making this business much more of a fee income based business. Very excited to announce to you that we are launching Gibson Re and what that does for our business on a go-forward basis. I'll end on this before we turn it over to questions. We are a unique specialty insurance company. We're a market leader in both of our businesses, and both of our businesses are experiencing strong secular growth. We're very pleased with where this business is heading, and thank you very much for listening. We'll now turn it back over for questions. We'll bring back up the video.
William Thomas, thank you indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just click Q&A, type your question and press send. Just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that recording this presentation along with a copy of the slides and the published Q&A can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. William Thomas, perhaps before we go to the live Q&A, we did have one pre-submitted question, and if I may, I'll just read that out and get your response, please. Why is the apparent success of the company not reflected in the share price, and what are you doing to explain to the market what RHIQ actually does in getting across your potential?
So I'll take that. It's a good question. I mean, we obviously don't focus on the market. We focus on putting up great results and articulating our strategy, and ultimately the market will recognize what we're doing, and hopefully our stock price will reflect that. I think it's Buffett that said, in the short run, the market is a voting machine, and in the long run, it is a weighing machine. We're going to do what we can to continue to produce great quality earnings, an easier to understand business model, and doing presentations like this, getting live questions. Hopefully we can explain our business and people will appreciate where it's going. As we simplify the story, we hope that the market will reflect that in our price.
William, thank you very much indeed. If I may just ask you both just to click on that Q&A tab. We've had a number of questions submitted during the presentation, as you can see. If I may just hand back to you, William, perhaps to just start at the top and read out those questions where appropriate to do so and give your response. Thank you.
Sure. Tom and we'll go through these. So the first question is, will you be reinsuring any of the existing Rnq book into Gibson Re? Good question. The answer is no. We are only putting in go-forward books of business as of today's date, and only deals where we haven't signed exclusivity. If we have signed exclusivity on a deal, that is going on as the old style, meaning we'll take the day one profit, but anything else going forward will be split with Gibson 80-20. The next question is, what is the incremental capital requirement within program management for adding an additional, say, $1 billion of gross written premium? Tom, do you want to take a stab at that?
Yeah, program management, the capital requirement is really to support our credit rating. It is a rating sensitive business. We tend to hold about 10% for every dollar of premium we write. So if we wrote $1 billion of incremental premium, we would be looking to hold around $100 million of capital against that to support our credit rating.
Good. Okay. The next question is, how do you win new business in program? How big is your sales team? Are you winning competitive tenders? Who are you competing with? So it depends on the market. So the first answer is there are not really competitive tenders. There are brokers that bring us MGAs, and we are therefore competing really on service or quality or reinsurance relationships. We get a lot of MGAs that come to us because they understand that we have 68 programs and that we can execute. So it's a very open market. I'll go back to something that I mentioned in the first half or in the 2020 results. The independent the MGA space is about $100 billion of annual recurring gross written premium. The independent program players, of which we are one of them, take about 10% of that market. The rest is in the hands of existing insurance companies who we believe deal with MGAs as a sideline. It's not core to their business. And an MGA takes existential risk if they work with an insurance company versus an independent program company. Because if an insurance company cuts them off, they're out of business. Whereas our sole job is to help an MGA grow their business. So we believe that 10% share will grow dramatically. And if it grows by another 10%, there's $100 billion, so there's $10 billion that comes to the program players. So we are not seeing a lot of competition fighting over MGAs. There seems to be enough for everybody, all the competitors, to get their share. In Europe, we only have 2 other competitors, and we're the leading player. In the US, there may be 2 handfuls of competitors. We're one of the largest, and at the end of the day, I think people focus on your ability to execute, and we have we are executing exceedingly well with 68 programs. Next question is Hurricane Ida. Will there be any impact on us? And the answer is no. There's no impact of Ida on our business. Next question is, are we telling the market that we can get 80% margins in program? And the answer is yes. We believe we can get between 70 and 80% margins is where we're shooting. This is the program management business has a lot of scale and a lot of operating leverage. And we've had to build the infrastructure over the last 4 years, get ourselves to break even. Now that we're adding premium, we're not requiring expenses to grow at anywhere near that level. Hence, we're at 40% margins today and going higher. I'm going to turn the next one over to Tom, which is, how do you see fixed operating expenses growing to achieve the fee income target by 2023?
Yeah. Our fixed operating expenses, we made a lot of investment in our fee business, particularly in program last year, where we started new branches and we started an E&S business. So that's effectively done on the program side. We don't see meaningful changes to what is really a fixed expense base. Legacy, now that we're turning legacy to a fee business, we're really leveraging our infrastructure today without incurring any meaningful new costs. We're going to leverage our existing claims management team, our existing origination team on behalf of Gibson Re. So frankly, we don't expect material increase in fixed expenses to drive the fee income we're going to get from legacy. So we think it's going to be growing the way modestly with inflation.
You want to read the next question, Tom, and take that as well,
Oh,
which was the allocation?
Sure, central costs. It was a question of this year we did allocate more costs historically that were in our corporate other segment for the half year in 2020. We're now moving more of what was unallocated corporate costs and allocating it to our program and legacy segment as we more readily identify the cost to support those 2 businesses. So this is a movement being done between 2020 and 2021. I don't expect any meaningful movements in that geography between corporate and the segments from here on forward. The last one is what prompted us to move to US dollars in the reporting currency. As you can see, we moved to US dollars starting in this year going forward. And that's because the majority of our assets, particularly on the investment side, are US dollar denominated. And we thought it would be more transparent and not have all the foreign exchange volatility flow through our income statement and balance sheet, is to report where the majority of our assets are denominated.
The next question is, we made reference to Gibson Re not cherry picking the existing Rnq legacy assets. Does the same apply to the existing $2 billion Gibson Re reserves? I.e., does Rnq have to participate in all of the existing book without prior underwriting? So the answer is that Gibson and Rnq are tied at the hip. Everything go on a go-forward basis. Everything comes through Rnq, and Rnq will cede 80% of those reserves to Gibson. So we are aligned. Now there are some exceptions where we don't have to send certain deals to Gibson. Those would be strategic transactions. But in general, when you set up a vehicle like this, you really want it to be aligned. We want alignment of interest. And the way to get the alignment of interest is not to allow Rnq to do some deals and Gibson to do other deals. That would not lead for a good relationship. So there is no cherry picking in either side. The next question is, who owns Gibson Re and Gibson Limited, and where is it incorporated? So we make mention that Gibson, well, first of all, Gibson is incorporated in Bermuda. It's a Bermuda domiciled company. We're not at liberty to disclose the names of the investors, but we had a lot of demand to participate. The investors that we picked were very sophisticated insurance investors, and we're pleased to have them as our partners. When you're opening up a new market like we're doing, you really want sophisticated people to be your partners, because we're doing this together. They're also deep-pocketed investors that we believe can grow with us. The idea here is not to do only Gibson One. It's not a hard market or soft market idea. It's actually part of our future, which is to continually raise these vehicles to support our growth. And our job, therefore, is to do a good job. We have to get the right returns for investors so that they want to participate going forward. Tom, I think the next one's for you, which is how much of your cash balance is unrestricted cash or free cash for Rnq?
Yeah. First of all the cash at our parent company is unrestricted. We maintain, when I think of cash, I'm including money market funds, around 15% of our portfolio is in cash and money market, and around half of that is encumbered in trusts to benefit the seeding company. The other half is unencumbered.
Okay. The next question is, to what extent have your results been impacted by the hardening rate environment? I would say at this point, very little. Where we're getting the benefit, it is on the program side, where if we have a policy and that policy is renewing, it's renewing at a higher price. We actually haven't looked at how much of our results are affected by the hard market, but I don't think it's a lot, although we're getting the benefit, and that's good news. But we haven't dissected it to say how much of each of our MGAs, how much prices increases versus volumes. Clearly helpful a little bit, but I don't think that's as we like to say, there's secular growth in both of our markets, and we're really getting the benefit of that. Next question is, can you describe Gibson Re's management structure and how it relates to Rnqs? It's a good question. Gibson Re is a collateralized insurance vehicle, really doesn't have management. It outsources the decision-making to Rnq in terms of which deals go in, 80-20, as we mentioned earlier. And then there's a third party that we have that is responsible for administration, reporting, accounting, et cetera. So there is no management inside of Gibson per se. The next question is, can you clarify what happens to Gibson Re at the end of the 7-year period? So let me just, we didn't mean to be cryptic on this. So what way this vehicle works is at the end of year 6, the investors in the fund, or excuse me, in the collateralized insurance company, and they have their own board, they can ask Rnq to go and seek liquidity for the whole book or for just portfolios of the book. We think we're in the best position to bid on those because we will have been the manager for the last 6 years, but they may decide that they want to go to third parties and let the third parties bid on it. So at the end of year 6, the investors, if they want, can ask us to go and have and seek liquidity. If they don't ask that, at the end of year 7, we are obligated to basically provide a commutation on that book of business, in whole or in part. We'll provide it in whole, and the investors can say, how about just this book or that book? We'd like to have a commutation on that. They are free to accept that price or not accept that price on the whole or on the portfolio. If they don't accept the price, then we're obligated to offer them an exit in year 8, and so on and so forth. So it can go on indefinitely, which is why we say that we'll have fees for at least 6 years. My guess is that we will be generating these fees and managing this book for longer than that. So when we provide a commutation, the next question is, how will you price it? And that's a very good question. We are going to price it exactly as we price books of business today. And we've said to you and to the market, we price it at 15% return IRR, and we will price at a 15% go forward return. So in year 7, we will look at what the reserves are. We will do our actuarial work. We'll look at the investment returns, and we will price to earn a 15% return on a go forward basis. So as we said, we offer an exit to investors, which is what they want. They don't need to take that if they don't want, and they think that there's still upside, but we can give them finality, and that finality is the same cost of capital that we bid at and look at legacy deals today. It's a new origination source for ourselves, or distribution source. And the final question, which I'll turn to Tom, is who will audit Gibson Re, and will it be Rnqs auditors?
That'll be a decision by the board of Gibson Re. So I think to be determined who they'll pick as an independent auditor.
I said final question, but it's not the final question. Is what upside can Rnq accrue? Well, what upside can accrue to Rnq if Gibson performs very well? We do have a performance fee. That performance fee is measured at the time that the vehicle has been fully exited. So it's so far out there. It's not that it's not meaningful. It is meaningful, but we didn't want to include it in any of our numbers because it is subject to what the returns look like, and it's probably payable in somewhere between year 7 and year 10, depending upon when the commutations occur and the vehicle has been fully realized. But there is upside, which is good for us and good for the investors. The reason it's in there is to continue to align interests. So I just want to make sure everyone realizes that Gibson Re and Rnq are working together. They're great partners that have invested in it. Our job is to get that vehicle great returns. We don't have to go to shareholders to raise additional equity for legacy, which is what we've done in the last 4 years. We move the business to be more fee-oriented. We have 20% at stake plus the fees. So our objective is to get great returns for the investors so that we can do Gibson 2 and Gibson 3. And it's, as I said, a core part of our strategy. And finally, who makes up the Gibson Re board? That's the investors. We're not on the board. The investors are the board. But again, the relationship is the Gibson takes 80% of our legacy deals going forward. I think that concludes the questions.
Fantastic. William, Thomas, thank you very much indeed for responding to every single question you've had through. And of course, if there are any further questions that are submitted, the team will have the opportunity to review those and we'll publish responses where it's appropriate to do so. William, if I may just ask you just for a few final words to wrap up before we redirect the attendees to give you some feedback, please.
No problem. Thank you. So thanks for listening or watching. We really appreciate your time. As you can hear from the excitement, or hope you heard from the excitement in both Tom's voice and my voice, we are really pleased with the way both of our business lines are heading. They're both growing well. There's a lot of demand for our services. There's secular growth, and we are executing against our 5-year plan. The first point of which is to move our business more to a fee-based business with less episodic earnings and a much capital lighter footprint. We're pleased with Gibson. We're really pleased with our partners. Thank you all as shareholders or future shareholders for supporting us, and thank you to the Gibson investors for also supporting us and investing alongside us and being our partners.
Fantastic. William, Thomas, thanks again for updating investors today. Could I please ask you investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete and is greatly appreciated by the company. On behalf of the management team of Randall & Quilter Investment Holdings Limited, I'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon.